video demonstrates how to calculate interest and prepare the journal entries to recognize interest expense and then payment of a note payable. Here we have Georgie Corporation. They've issued a 60-day 7% note for $44,000 to pay an overdue account. Georgie's year end December 31st. We are to assume a 360-day year is used for the calculations. Calculate the maturity date first. Prepare all of the necessary journal entries for the note. So on the right-hand side of the screen, you see the calculation for the maturity date. Georgie is establishing this note in November. There are 30 days in November. The note is being established on the 23rd, so subtraction. 30 minus 23rd means that 7 days in November will accrue interest. And then we'll pick up the full month of December, 31 days. So the total number of days for 2026 would be 38. Going forward into January up until the 22nd gets us our total 60 days. So the note is going to mature or be due on January 22nd. Now let's prepare the journal entries. On November 23rd, we were told that Georgie issued this note to pay an overdue account. So that means we're going to remove the accounts payable with a debit, and we're going to issue the notes payable. Let me direct your attention to the light blue just underneath the interest expense and interest payable. So to make this calculation, we take the principal amount, $44,000, times the interest amount, which is 0.07. When your quoted interest is typically for a full year, an annual rate, so we have to consider the component of time as well. So we're only accruing through the end of December, so that's, remember, 38 days based on our calculation. So 38 days and divide by 360. The full calculation needs to be put into your calculator. 44,000 times 0.07 times 38, divide the whole thing by 360, you get $325.11. I just rounded to the $325. This is the amount of interest expense that will be accrued for the year, and interest payable will be recorded with a credit to interest payable. Now let's go down to payment of the note. Now let's examine the journal entries that would be required at the maturity of the note. The note matures January 22nd of 2027. When this note is paid, we'll have a debit to the notes payable for the full principal amount, $44,000. Remember, the interest payable was accrued at the end of the year, so this is being satisfied now as well. So we want to debit that amount. And then skip over to the right-hand side. The full amount that has to be paid is your first calculation you see underneath in the light blue. Principal amount times the interest of 0.07 times now the full term of this note. 60 days divided by 360. It works out to be $513 and some change. This is the amount of full interest that must be paid when this note is satisfied. So the check will be written for the principal amount, $44,000, plus $513 in addition that would represent the interest. So after that, you can go in and plug this number if you would like. The total on the debit side has to be equal to the total on the credit side. Also, it's a great idea to go in there and calculate and make sure that the days work out. The total amount of interest, remember, $513.33. That we calculated, and then minus the $325.11, which was accrued at the end of December, means the new interest expense, this would be for the month of January now, should be $188.22.